So I want to talk a little bit about my Power 3 concept. Now, I'm not going to go into great detail here, but I do have lectures on this YouTube channel that cover this, and it's mentioned and laced throughout a lot of the teachings. So I'm a firm believer of repetition makes mastery. You have to see things over and over again to condition your mind and your eye to see it. You can't just watch a video, and you can't watch a 5-minute trainer or a condensed version of what I'm teaching, because while you may feel like you watched a shorter version of my content by someone else, that is not teaching you anything except for the same thing you get with Cliff Notes. Okay, it doesn't compare to the full detail. So Power 3 is not linked to any one particular time frame, but when I first introduced it, it was appropriate at the time to teach it on a daily chart. Okay, so let's look at this with the reference of a weekly range. The low of the week, where we started trading here at the open. In other words, this is an open, high, low, close bar. Most of analysis is done on candlesticks today. Okay, I know I have moved away from this type of chart, which is how I used my commodity charts and S&P charts and bond charts back in the mid-90s when I first started trading. Then over the years, my eyes have, unfortunately taken a toll at looking at screens for a long time. It's a lot easier to read the data with a candlestick now. But from a Power 3 stance, the open, the decline below the opening price, the rally higher, making the high of the day, and then the close near the high of the day. This is Power 3, where we anticipate the market moving higher on the basis of a weekly analysis, higher time frame analysis. We think that it's drawing to a premium array, something to make it want to go up here or draw to it. And so on Sunday when the market's open, we anticipate, if we're bullish, that opening price or this opening price at midnight New York local time. It can open, drop down. We would not see that as bearish. We would anticipate that. So it's the accumulation phase below the opening price. The manipulation is the open and then decline, but we're utilizing that function to accumulate long positions. Or, for the purpose of studying, we would anticipate it opening, trading down into some discount array. What would that be? A fair value gap, running short-term sell stops on a lower time frame, trading down to an old high, something that would promote some discount or quote-unquote a support level. Then the market would displace higher above the opening price, return it into some kind of imbalance that would be seen with a bullish fair value gap or a bullish breaker, and rally up. So this is the expansion portion of Power 3, then creating the extreme high of the week, and then trading off that high to close. And this would be the distribution phase of Power 3. So it's open, high, low, close, accumulation of longs at that opening price and down when it drops below it. This is manipulation. This is where retail traders would chase that move lower, and then they get raked across the coals as the market goes higher, reaching towards some higher time frame premium array, some kind of target. Okay, think of it like I've outlined here. The market has been drawing each week up into this area here. Well, that's each one of these open, high, low, and close would be represented by each individual candlestick here. So even though these are candlesticks, this candle here would be represented by the open, then it traded down, then it rallied up, made the high, and then came off the high and closed near the high. Same function, but I'm teaching Power 3 with this open, high, low, close bar. And obviously everything I do is reversible, just whatever I've said in previous. For when it's bullish, you would just use it when it's bearish. It would open, the accumulation of short positions when you think the weekly candlestick is going to go lower, reaching for some kind of discount array, some kind of sell side liquidity, something to that effect. You would see the opening price and then rally up. We would see this open as accumulation of shorts and then manipulation higher, tricking retail traders into thinking it's going to break out to the upside. Smart money would accumulate short positions here and then ride it down throughout the week, reaching to some discount array, and then before the end of the week, it comes off the low, closes on Friday's close. Near, but off the low. So I want you to understand that premise. Now, this theory of mine is not limited to a weekly. It's not limited to a daily chart. It's on every time frame. Every single time frame. So as long as you know where the next draw on liquidity is, regardless of what time frame you're trading, what style of trading you're utilizing, this idea of understanding accumulation, manipulation, and distribution will serve you well in terms of finding setups, sticking to institutional order flow. In other words, trusting that price is going to continue moving in your direction if you're on side. If you're off side, it means you're incorrect about what you think is going to happen in the marketplace. Then you're obviously going to get stopped out, and that goes without saying. But assuming all things equal, if you're right, this is how we interpret price action.